Okay, so thank you for everyone joining us today on this gloomy Wednesday for our presentation on year-end tax planning tips and strategies. As you see, we are joined today by attorney Bill Wilson, who is the owner and co-founder of our law firm, Wilson & Wilson Estate Planning and Elder Law. Today, we are joined by UBS Financial Services. We have Kevin Daugherty and Kristen Plotkin. Kevin has had exposure to the wealth management industry his entire life. He grew up watching his father build personal relationships with clients and their families and aspired to do the same himself. After graduating from Arizona State University in 2006, Kevin joined the industry as a wealth planning analyst. In this role, he supported over 150 financial advisors and cultivated a strong foundation for planning and communication, allowing him to refine his own practice. Now, Kevin and his father run the Daugherty Group, a wealth management practice at UBS. Early on, Kristen discovered that one of her passions is to help others build confidence in their future, particularly when it comes to their wealth. And she's been committed to doing this for over a decade. Upon graduating from DePaul University, Kristen began working at UBS and held multiple roles with a focus on developing efficiencies to enhance the client experience. Now, she's incredibly proud to be a financial advisor with the Daugherty Group. Together, the Daugherty Group is committed to helping a select number of clients understand what is possible. Beyond helping clients to make smart decisions about their investments, they focus on identifying tax mitigation, wealth transition, asset protection, and charitable giving strategies. They are most proud of what they see their clients living in an amazing life of significance, which to them consists of taking care of the people they love, supporting the causes they care about, making a difference in the world, and spending more time doing the things that bring them joy. We'll get started in just a minute, but a few housekeeping items. We're going to have some question and answer portions of this presentation. So you'll see at the bottom of your screen, if you roll over the video portion here, you'll see a Q&A box. Feel free to type in any questions at the bottom there. You'll also see a chat box. Feel free to go ahead and put any questions or comments in there as well, and we'll be sure to get back to you as soon as we can. If you would like to ask a question verbally, feel free to click the raise hand button. There's a little icon that looks like a hand at the bottom of your screen. Feel free to click that button and I can go ahead and make sure that allow you to unmute yourself so you can ask that question as long as your microphone on your electronic device is working. So with that, I pass it over to Bill, Kevin, and Kristen.
Great, thanks, Kayla, and thanks to the Wilson & Wilson Law Group for inviting us to join this conversation today, and for you all for joining us as well. I think the year end is a time when we reflect on, a lot of us reflect on, what's been accomplished this year, what we may have left to do, and kind of what we envision in the years to come. So more broadly speaking, what we're seeing is that there's a lot of uncertainty in the world today. There's a lot of questions on people's minds about kind of what's ahead and how it's going to impact them. And people are also kind of motivated to take action right now. There's a need for guidance and a need for a coordinated effort. So we think this is a great time to be considering, taking action on some items pertaining to taxes, to setting your family up for success, to protecting what you've worked hard for, and if it's important, to giving to those organizations that are important to you. So our goal over the next 45 minutes or so is to really leave you in a place where you kind of know what the current planning landscape looks like, and why this is a good time to be thinking about how it impacts your plans, that you have some actions to consider taking before year end, and most importantly, that you feel like you have people to turn to that can assist you along the way. So we're going to kind of have a little conversation here. I'll ask some questions to Kevin and Bill, and on a few different topics. As Kayla mentioned, we'll pause throughout to open it up for any questions you have. So please feel free to type them into the Q&A box, and we'll address those in those times, or also feel free to raise your hand and we'll call on you then. So Bill and Kevin, you ready?
Yeah.
Great. I think we've all heard about the potential changes coming from Washington. There's, obviously the infrastructure bill and how it's going to be paid for, and there's no shortage of information and coverage on the proposals out there. What's the latest? Kevin, do you mind kind of sharing what the latest is? And Bill, if you have anything to add,
Sure.
maybe follow that.
Yeah, happy to share what we know is the latest. I think to summarize it most easily, it's probably that a lot of the proposals from earlier in the year look a lot worse than what may end up actually being put in place by the end of the year. Still a lot subject to change, but I'd say even over the last couple of weeks, we've seen a lot of the kind of more feared tax proposals from an individual level either get dropped out or improve in terms of what they may look like. So I'd break them into probably three broader categories. One being what's happening with capital gains tax. Second would be what's happening with income tax brackets and rates, where there were some concerns around where the line would be drawn in terms of the highest income tax bracket. I think the last part is just the estate tax exclusion amounts that are scheduled to change here in a few years, but there were some concerns that those could come down sooner. So I'll tackle those three. And again, still subject to change until a final bill's put in place. But from what our political folks have seen, getting very close to these things getting put into legislation. So I think from a capital gains perspective, there are a lot of concerns that, especially in the higher tax brackets, that capital gains rates could skyrocket. Some fears earlier in the year were to as high as 38 to 39% for capital gains rates, which are currently 15%. Unless you're in the highest tax bracket, then it's 20%. And from everything we've seen recently is that's likely to not change at all, that those rates should stay the same, and the levels at which they kick in should stay as well. So I think that's alleviated a good amount of concern from us. An interesting part of the proposals that were written around that law were that the law was going to be passed retroactively, meaning transactions after a certain date would all be subject to the new capital gains rates, which wouldn't have left many people time to react and realize gains at that lower level. So I think overall, that's a positive. From a tax brackets perspective, there was a lot of talk around drawing the line for the highest income tax bracket at a much lower level, as low as 400,000 or 450,000 for a married couple filing jointly. That also looks like that's no longer on the table, that the tax brackets will stay as they are. There will be some extra taxes for people making over $10 million a year and making over $25 million a year, but obviously the number of folks that fall in that category is much lesser than the individuals and families that fall in the income tax brackets above 400 and 450,000. So I think that also is a pretty big positive. And then when it comes to estate tax exclusion amounts, which are scheduled to be $12 million per individual, $24 million per couple in 2022, there was concerns that could come down to a much lower level, and it looks like that's going to stay put for the time being. The way the law is written is for those limits to drop back down in either 2024 or 2025. So I think there's still, as Kristen said, if there's some motivation to take action on a lot of these things. Now it's not a bad time to continue to follow through. I know a lot of attorneys like Bill were concerned they were going to see a huge rush towards the end of the year of people trying to get different planning strategies and work done. So it doesn't look like that urgency will be there for the end of the year. But I think in all cases, our suggestion is that this is a good reminder that when tax policy changes, it changes quickly, and sometimes we don't have enough time to react. So to us, it's all the more important to start looking at, what can we do proactively now before the end of the year and in the next couple of years to get ahead of some of these changes that may be coming at us.
Great, thanks, Kevin. Bill, anything to add there?
Yeah, concerning the estate tax exclusion amount, again, that's how much your estate is worth when you die and what taxes you're going to pay on that. Kevin outlined it pretty well. Next year, the exclusion amount is $12,060,000, and in 2025, that's supposed to sunset, meaning there's not going to be an estate tax, but obviously they'll put one in, and we're looking at something like 5.6 million, which is, as Kevin alluded to, is very, very low. And again, that could change. Most of the people in Congress and in the Senate, they're millionaires, so they want to protect themselves too. So I don't see that going down much below 5.6, but we never know. Just and this has nothing to do with the federal estate tax, but remember, Illinois has its own estate tax, and that's at $4 million. So we can't forget that. You may not have a federal estate tax, but you may have a Illinois estate tax. So that's always something to keep in mind.
Yeah, definitely. Talking a lot about taxes. So kind of from a tax standpoint, what are some things that individuals and families should be considering, especially at year end? Kevin?
I'd say to me, it's more than anything else is just being proactive in how you think about taxes. I think our experience is a lot of people are very reactive and just deal with the consequences as they come at you. So I think there's a couple big areas that we tend to see where individuals and families have the ability to be a little bit more proactive, and in the spots where they tend to have some embedded tax liabilities that they'll have to deal with at some point in time. So I think one of the big ones that we always encourage our clients to look at getting into the end of the year is, how much do you have in pre-tax retirement accounts? A lot of folks end up with some pretty big balances in those pre-tax retirement accounts, and I think one of the common things we see is to hold off on taking money out of those for as long as possible. The problem with that strategy is at some point the government's going to force you to take dollars out, and once they force you to start taking dollars out, it's the amount they stipulate in their calculation, and you don't have a lot of flexibility with it. So something we encourage our clients to take a look at is to say, hey, how much income do you have now? What could your income look like in the future? And certainly we can help run some of those calculations based on different retirement account values currently and what they could look like in the future. And see if it's worth taking some money out of those retirement accounts now and potentially converting those assets over to a Roth IRA account, which is then going to grow tax-free over the course of the rest of your life, and will pass on to your heirs tax-free as well. So I think there's a lot that can go into that consideration, but I'd say if you're looking at yourself and you're one of those folks that has a good amount of money in retirement plans, I think it's pretty common for us to see clients with 50, 60, 70, 80, 90% of their net worth in retirement accounts if they've worked in corporate structures most of their life. And if you find yourself in one of those categories, I think it's worth proactively looking at, hey, can we put a better distribution strategy in place, knowing that, hey, if we have $1 million or $2 or $3 million in retirement accounts, that full value is subject to taxes, and 2, 3, 4, 5% tax rates adds up to a lot of money over the course of time. So I think being proactive with pre-tax retirement accounts is certainly one thing to be considering at year end. I think also looking in non-retirement accounts at your portfolios and reviewing positions just to see how much gains and losses you have on different positions within your accounts. We like to do a strategy called tax loss harvesting at the end of each year, which is really taking a look and saying, hey, are there any positions that are currently at a loss that we could sell and realize to help use to offset against current gains in the portfolio or future gains in the portfolio? So certainly think doing tax loss harvesting makes a lot of sense. And I think it's also a good time to just deal with or take a look at kind of bigger positions or concentrated positions that you may have in your portfolio, especially if they have some bigger gains embedded in them. There'll be a couple other strategies I think we touch on over the course of this meeting to help find ways to chip away at it. But I think those are some of the things that we tend to take a look at. And I think the last one would be if you have inside of a 401k plan, if you have any after-tax balances, that's something I didn't mention in terms of the latest from Washington. Right now, you can convert those after-tax balances in a 401k plan to a Roth IRA account. It's looking very likely that after December 31st of this year, that will be no longer available. So I'd say it's certainly worth checking your 401k if you have an active 401k plan to see if you do have an after-tax balance. If that's the case, it may be worth kind of getting on top of it and considering rolling that into a Roth IRA account before the end of the year.
Kevin, what is the advantage of rolling a regular IRA into a Roth?
I'd say the biggest part is going to be the tax treatment going forward. So once the money gets into the Roth, any growth is going to accrue on a tax-free basis. Any distributions from that Roth IRA account, as long as it's been open for 5 years, can come out on a tax-free basis as well. You're also not forced to take any required minimum distributions on Roth IRA accounts versus with traditional pre-tax IRAs. You do have to take those required minimum distributions starting at age 72 currently. And I think the other benefit is that it passes on to your heirs tax-free. The way inherited IRA accounts are handled has changed in the last couple of years. Previously, if an individual were to inherit an IRA account, say from a parent, they'd have the rest of their lifetime to distribute those assets. And a couple of years back, the IRS came out and said, we're not going to allow that to be the case anymore. Any inherited IRA has to be fully distributed within a 10-year time frame. So I think it's fully beneficial for the current account owner, but then it can be a very good kind of longer term estate planning or legacy tool as well.
Okay, thank you. Yeah, I have nothing to add on that. If someone wanted to just start a Roth IRA, isn't there some ceilings on income that you must adhere to?
Yeah, so it's easier to convert to a Roth IRA than it is to contribute in most cases. There are income limitations for a married couple filing jointly. It's around $200,000 in income that if you're above and beyond that, then you can't contribute straight into a Roth IRA account. Most 401k plans do have the ability to contribute on a Roth basis now, which is something that wasn't available going back a couple of years ago. So those are a couple other ways to get money into those tax-free structures. But we just really feel that if the government balance sheet continues to head in the direction it's heading, that tax increases are likely as we move forward. So, if we can locate our assets into different structures that are protected from those increases, or kind of avoid them altogether, that becomes a great strategy moving forward.
Okay.
Any questions from the audience? I don't see any in the Q&A box, but Kayla, if you don't mind checking the chat, that would be great too.
Yeah, there's nothing in the chat box right now.
Okay. Feel free to click the raise hand button if you'd like us to open your line up for a question. Okay. We'll keep going. At this time of the year, many of us spend time with our family and those who are important to us. Bill, do you mind sharing kind of what some of the things are that we should be considering at this time of the year when it comes to taking care of our family from a wealth transition standpoint? And then Kevin, if you have anything to add after Bill, that'd be great.
Sure. There's many things that we should look at, and I'll just hit a couple. As I said before, remember there is a state inheritance tax, or a state of Illinois estate tax. So if you're inching up to that $4 million, you should contact your advisor or your attorney to see what you can do to either minimize or eliminate any possible estate tax. Remember, it's at 4 million and the tax itself is draconian. So, I mean, it stands to reason, because let's face it, Illinois is broke. So they have to resource funds from somewhere, and that's why they instituted this estate tax, which they did away with several years ago. So that's one thing to look out for. Also, check your beneficiary designations on IRAs, life insurance, any retirement accounts, annuities. I have couples come in, and we always check those accounts for the beneficiaries. And many times one of the spouses will have their father or their brother or someone else.
Their ex-wife.
Ex-wife. That is totally inappropriate. So check those and make sure is the beneficiaries are the people that you want to be on there. So that's really important. If you have no estate planning documents, I mean, and many people don't, so don't feel bad if you don't. We always suggest what we call the big four: the will, trust, power of attorney for health, and power of attorney for property. Remember, your powers of attorney for health and property are the most important documents while you're still living, because they're the documents where you appoint someone while you're still living, and you're unable to make decisions about your health care or your financial concerns, and you're appointing that person to make those for you. They cease upon death, but again, while you're still living, we feel that they're most important. Also, with the power of attorney for property, and this is real important, banks hate powers of attorney for property or finances, another way to put it. They feel that people come in and abuse them and take out funds when they shouldn't be taking funds. So many, I shouldn't say all, many try to find any way to deny them. So if your power of attorney for property is more than 5 years old, there's a good chance they're going to reject that. So take a look at that power of attorney of property, see when it's dated, and if it's more than 5 years old, I would suggest that you get a new one. Also, your bigger banks, Chase, Bank of America, those banks at that level, many times will not honor a power of attorney that has been drafted by an attorney. So what we tell people is to go ahead, take the power of attorney that we've drafted for you and take it to that bank and see if they'll honor it. What they do is say, no, we're not going to honor this, but you can use our own power of attorney form. So that's what I would do with these larger banks. Even with the smaller banks, make sure ahead of time before you need them that you check that out and make sure that they will honor that. Because the worst thing that's happened, and it's happened to us, you get a power of attorney, the person, what we call the principal, was named an agent. That agent goes in and wants to use that power of attorney, but they say, no, I'm sorry, we're not going to honor that. But the principal cannot sign a new one because he or she is incompetent. So then we have to go to a guardianship. So that's a roundabout story on how you should make sure those powers of attorneys are timely. So the other concerning trust is that remember to fund those trusts. A trust is really invalid, or it's not worth anything if you don't put assets in it. So what we do is we put your significant assets, your house, any investment accounts, bank accounts that are significant, we transfer those into the trust. And again, remember the number one reason why we do a trust or draft a trust is to avoid probate. If those significant assets aren't in the trust, then those are going to go through probate. And then you've wasted a lot of money getting and paying for these trusts, and they're not worth anything. There's a couple things about if you do have an estate tax problems, there's things you can do. You can use the exclusion gifts, which have the annual exclusion now is $16,000 per year. It was $15,000. You can use that to gift monies to different people, kids, grandkids, whatever, and that lowers your taxable estate. You can fund a 529 plan, do the same thing, and you can pay for tuition or health care for, say, a grandchild. That would lower your taxable estate also. You can also fund an IRA for a kid, and maybe Sean can talk about that, about setting up for an IRA for a kid that ordinarily would not set one up. So, and lastly, we had a webinar on this. It was a webinar on family meetings. It's I think a good practice at the end of each year is to bring the family. I mean, you can decide how extended that family needs to be, but usually the parents and the kids, and show them, you don't have to give them exact amounts, but show them what's going on with finances and how different things work within the plan that you have. And so this gives a good primer on how finances and estate planning dovetail together and how they can learn. Let's face it, they don't learn this in college, so it's something that they would be a value added to them. So that's about it on what I would suggest people look at, but by no means is it exhaustive. Kevin, do you have anything to add to that?
No, I think you hit the big ones that I would suggest. I just probably put an emphasis on those family conversations, and I think they can lead to a lot. I think a lot of our clients hesitate to get too far down the road and open up those lines of communications. But I think, you know, you can certainly watch the webinar we did before. I think Bill's got a recording of it, but you know, it's just, you can pick what you're going to talk about. You can pick what you're not going to talk about. And I think if you do that going into those conversations, you can have a productive conversation, even at a very, very high level and without talking about dollar amounts. So I think that's certainly a good recommendation. And then, yeah, I'd reiterate the gifting side of things. I think we've had a lot of clients kind of gravitate towards helping, you know, either kids or grandkids. They're starting to have earned income, you know, fund an IRA account or a Roth IRA account, because it's a nice gift, but it also helps to start to build the discipline of you know, having the younger people in the family start to look at you know, retirement accounts for their own, start to gain an interest in a discipline and funding those accounts and paying attention to them over the course of time. So I think those are all great strategies.
Great, thank you both. Bill, one question for you. I like the concept of the big four. At what age, or is there an age that you should start considering that, getting some of those basics in place?
Well, you should always, I think, at least have the powers of attorney and property in place coming out as soon as you're 18. Okay, so that's age of majority. So at least 18. When you start to gain wealth and significant assets like a house, then you should look at the trust and, you know, maybe the will too. If you die without a will, the state of Illinois says that half go to your parents and half goes to your siblings. And there's different combinations if you don't have parents or siblings, but that's basically what's going to happen. So if a kid, my son's 23, so if he doesn't want anything to go to his parents and just wants them to go to someone else, then he should have a will. If he doesn't care if it goes to his parents, then really a will is, I shouldn't say not needed, but there's a lesser
Urgency for it.
Yeah,
yeah, there really is. So
thank you.
that would be my advice.
Kevin, next question. What are some of the year-end actions to consider when it pertains to wealth protection? In other words, protecting kind of your assets and the things we've worked hard for.
Yeah, I think a couple of things to keep in mind. I think the first one, for people that are still working, I think this time of year tends to be a pretty common time for open enrollment. So a lot of times it's when you select your different coverages that are available to you through work, whether it's healthcare or disability insurance or life insurance. So I think it's always a good time to revisit those when you go through open enrollment and just see, hey, what am I getting either for free or what am I paying for through my plans at work from a wealth protection standpoint. So I think that's a great place to start. I think beyond that, it's always worth and probably every year, every couple of years, evaluating, hey, do I have life insurance? Do I have disability insurance? Do I still need it? We work with plenty of retired clients who still have large amounts of life insurance, and we say, you know, if it's for risk management purposes, you know, you probably don't need as much as you once did. If it's for investment purposes, then it maybe is a different conversation. But I think reviewing those coverages, again, both on the life insurance and disability side, make a lot of sense. I think one thing that seems to be a weekly occurrence now is you know, talking to somebody, either client or friend or colleague, that's had some sort of issue with identity theft. and whether it's through the state of Illinois unemployment system, we saw a ton of those in the last year, people filing bogus unemployment claims in other people's names, or just getting access to information and opening a credit card. I had a conversation with a client earlier today who's trying to get it fixed, and it's not fun to deal with. It usually gets fixed, but it's still just a pain. But so I think two things you can do there. One is just check your credit report periodically. I think an end of year exercise can be a good exercise to check your credit report. And then I think if you're not in a situation where you're opening credit cards frequently or applying for loans or extending credit in any other way very frequently, we generally recommend freezing your credit with the 3 different credit reporting agencies, which is really going to be a big barrier to anybody opening up lines of credit in your name. So I think both of those things combined can go a long way in kind of protecting from those unforeseen identity theft issues. And like I said, just happening more and more often. So I think it's a bigger thing to consider than it was even a couple of years ago, and probably a couple of years from now, it will be a bigger thing to consider than it is right now. So I think those are a couple. I think one other thing that we've seen as a benefit to a lot of our clients is just actually taking a deeper look at your home, auto, and umbrella insurance coverages. I think pretty frequently we find if we have a thorough review done there that there's some coverages that could be better positioned. If you don't have an umbrella policy, I'd strongly consider taking a look at doing so, just from an extra asset protection standpoint. And then I think the last one is, and maybe not an end of year topic, but an as you get older topic is just around long-term care planning and conversations. As the population grows older and people live longer, there's just a greater likelihood that people will need help along the way. I think one of the fastest growing demographics is kind of middle-aged to older women becoming full-time caregivers. And so I think there's certainly some financial strategies that you can tap into to start to protect against that. But I think there's also some just general planning and conversations that can be good to be had amongst the family to prevent issues to make the hard situation as streamlined as possible. So I think when I think about wealth protection and end of year, I think those are generally some good things to think about and start to take a deeper look at or have some conversations around.
Great, thank you. And we're closing in on kind of the last question here, but Bill, before I ask you if you have anything to add there, just want to see and give everybody an opportunity to again ask us the questions that are on your mind. Feel free to use the Q&A feature or raise your hand and we'll call on you. But Bill, anything to add?
We do have 2 questions in the chat regarding required minimum distributions. I have 2 questions from the same person. So one, if you guys are taking questions like that right now.
Yeah.
The first one saying, is it likely that the RMD age will increase to age 73? And then the second one is regarding, it says, in Illinois, can an under RMD aged person direct a transfer to a charitable entity on a tax-free basis?
So the answer to the second one is, I believe, is yes. So we call them charitable IRA contributions. And previously, the age at which you could do a charitable IRA contribution was aligned with the required minimum distribution age. So it used to be age 70 and a half for both. With this more recent rule change, age 72 is the age where you have to start taking required minimum distributions, but age 70 and a half remains the age at which you can start making charitable IRA contributions. So yeah, you do have kind of a year or 2 span in the middle there where you can do a charitable IRA contribution before being subject to RMDs. In terms of the RMD age getting pushed back to age 73, that's a hard one to answer. I'd say I wouldn't expect it to happen all that soon, given that just in the last 2 years, the age has been bumped back from age 70 and a half to age 72. Last year, due to the pandemic, the IRS suspended RMDs for the year. Nobody had to take an RMD in 2020. We had a lot of clients saying, hey, is that going to happen again? And I told them it's not likely. A lot of tax revenue comes from those required minimum distributions. So I'd say I'd be surprised if it got pushed back over the short term another year. Longer term, I wouldn't be surprised at all. with longevity increasing and people living longer, and people working longer also, I think is another trend that we continue to see is, people, we have a lot more clients working into their 70s and having to take RMDs while they're still working. So I think longer term, I wouldn't be surprised to see that age push back, but knowing that recently the age was changed, I wouldn't expect it in the next couple of years.
Great questions. And we have a piece called Year-End Planning Strategy Guide that we'll share with everybody, and it speaks directly to that second question on making qualified charitable distributions too. So great questions.
One of the additions to the asset protection that I just want to bring up real quickly is that if you own a residence, you should have that with a spouse, you should have that residence in what we call tenancy by the entirety. And what that does, if it basically protects the house, if one of the spouses is sued, the creditor cannot come after the house. If both are sued, both spouses are sued by the same creditor, they can. But that is very, that really doesn't happen too often. It's usually one of the spouses is in a high-risk job and that person gets sued. So to keep it in tenancy by the entirety, which you can do through a trust, it will protect, give you an added amount of protection for any creditors or judgment creditors out there.
Great.
That's a good tip.
Yeah. I think final question here. At the end of the year is a time when people tend to feel philanthropic and desire to kind of make an impact on causes that mean a great deal to them. What are some of the things to consider when giving to charities at any time, but particularly around the year end? Kevin?
Yeah, I think, when we think of charitable giving, a lot of what we try to position with clients, especially in the last couple of years, has just been, how can you maximize the tax benefit of your charitable gifts? I think we always like to start charitable giving conversations with what's your charitable intent. If you have one, then let's talk more about it. If you don't, then we're not in the business of trying to talk people into give money to charity unless it's important to them. But when it is important to you, I think there are some things that can help to try to maximize the tax benefits of giving those gifts. I think, to me, it starts with taking a look at, hey, what does this year look like from an income standpoint? What is my tax filing going to look like? Over the last couple of years, with the SALT state and local tax deductions coming into play and the standard deduction going up to $24,000, we've seen a lot less people itemizing their deductions. Charitable contributions tend to be some of the more frequently used itemized deductions. So, if you're in a year where you're not likely to itemize, then maybe it's not the best year to make bigger gifts to charity. If you are in a year where you're going to itemize, or you're in a year where you have kind of bigger income than you may have a year or two from now, or 3 or 4 years from now, then maybe it's a good year to use those deductions. So one concept we've talked a lot about to our clients is just the concept of kind of grouping charitable contributions into those years, so that you can itemize your deduction, and so you can kind of use it when your tax situation is going to be the worst. And a lot of people will ask, well, I'm not just going to give money to charity this year and then not the next couple of years. And there's a couple tools that can be used to group those charitable contributions wisely. One of the more commonly used ones and easier ones to use is something called a donor advised fund, which allows you to pre-fund your charitable contributions. And so you donate, say, $10,000 into a donor advised fund, you get the tax deduction in the year you make the gift, and then the funds sit in that donor advised fund, and you get to give the money out to qualified charities over the course of an extended period of time. So you get the tax deduction now, and you can figure out what you're going to do from a actual gifting to the actual organization standpoint over a longer period of time. So we've seen those tools come in handy in a lot of different ways. So I think that's one tool. The question around charitable IRA contributions, if you're at those ages, we think that's a great tool to use, especially if you have significant required minimum distributions, because those charitable IRA contributions will help to offset any required minimum distributions you have. So I think both of those can be very good tools. And I think separate from that, we question our clients a lot around, hey, what's the best asset to give to charitable organizations or into these types of structures. We see a lot of what we call checkbook philanthropy, which is where people see a cause that's important to them, they write a check. They get the letters at the end of the year during the holidays, and they write some checks without really thinking about, hey, is there a better way to go about doing this? One easier way to do it is through taking a look through your portfolios, and if you have non-retirement account investment assets that have some even smaller taxable gains in there, but especially ones where there's larger taxable gains, or maybe you don't have cost basis on a certain position, we strongly encourage our clients to say, hey, why don't we gift those appreciated securities to charity rather than cash? Because in doing that, we can avoid paying capital gains on that security. Most charities are set up to receive securities in lieu of cash for donations. And so you don't pay the capital gains taxes on that portion that you donate. The charity receives it, they can sell the securities, they don't have to deal with any taxation there either. So I think those are a couple of things to consider. Just, hey, is this a good year to do it from a personal standpoint? Hey, are there vehicles that we can use to kind of front load those gifts? And then, hey, when we are going to ultimately make the gifts, what's the best assets to use, right? It could be cash. It very well could be cash. It could be an appreciated security. It could be a retirement account if you're past age 70 and a half. So I think just being a little bit more not necessarily open-minded, but just kind of open to the different structures that are out there. And I think that's part of what we work with our clients on, is just educational, to say, hey, here's a bunch of different options that are out there, which ones may fit with your strategic plan of giving over the course of time.
Excellent, thank you. Bill, anything to add there?
Yeah, and this is more of a practical analysis. When you look at a charity, each charity has to file what's called a 990 form at the end of the year, and that form is just pregnant with information about the charity. So one of the places that I go to is called Charity Navigator, and look up the charity, and they should have the 990 form on there. And what you want to look at is, there's a couple benchmarks that I use, at least one, that 75% of the income is going to programs, not to administrative costs or salaries. So you want to make that as your benchmark. You want to look to see whether that charity is growing or shrinking. Because if it's shrinking, then their effectiveness in carrying out their mission is probably being lessened and lessened. You want to look at where they're getting the support. Many charities get support directly from the federal or state government, but you want to make sure that they're also getting private support, because state and federal support, you never know how much you're going to get, when it's going to stop, and there's just so many variables there. So you want to look to make sure that they're getting private support from grants, those type of things. On page 7 of the 990, it'll show you the CEO's salary. So take a look at that, and take a look and compare that to what their revenue is, and just make sure that it's in line with what it should be. And I can't give you any hard figures, but if the CEO is making $1 million and then they're only bringing in, say, $100,000 in revenue, there's something wrong there. And I would certainly look for another charity to give to. And finally, there's many ways we can use estate planning, and this can be a subject of another webinar. For charitable contributions, there's what we call a charitable remainder trust, there's a charitable lead trust, and there's what we call a gift annuity. So that'll be something that we could look at and do a webinar on, but that's basically my contribution on giving to charities at the end of the year.
Excellent. Well, Bill and Kevin, thank you so much for sharing all the insights and things to consider at this time of the year. I think, we, on behalf of Kevin and I, we really appreciate the opportunity to share in this event. And thanks to everybody for joining. I think, Bill, I want to hand it over to you to make some closing remarks.
I
Okay.
do have one more question that came in on the chat box regarding IRAs, if that's okay.
Yeah.
So it says, can IRA money be moved to tax-free to a donor advised fund? If so, is there a limit per year or in total?
My understanding is no, it cannot, the money cannot go from an IRA to a donor advised fund.
Okay, thanks.
Well, great. Thank you for everyone attending today. Remember, if you have any topics that you want us to explore during a webinar, certainly send those in and we'll do our best to put something together. It seems like today there was a lot of questions about retirement, IRAs, all that stuff. So that could be a webinar in itself with Kevin talking about those different rules and different strategies. So any topics that you feel that you want to know more about, just tell us and we'll do what we can. This webinar is being recorded, so it'll be on our website. Oh, when do you think, Kayla? Couple weeks?
Yeah, I'm hoping for first week of December.
Okay. All right. So in the meantime, please reach out to Kevin or myself if you have any questions about what we talked about today or any other financial or estate planning questions, and we'd be happy to help you guys. We will not have a webinar next month. We'll start again in January. And if we don't see you before that, please have a great holiday and we'll see you in January.
Thanks, Bill.